Okay, let's talk about the global cues then. Here's Sonal with the world view.
Thanks a lot for that. And in the US markets, the indices, they closed in the green after a very choppy trading session. And all the major indices, they reacted to the minutes of the Fed meet, where the central bank indicated that it would be patient with future rate hikes. They also said that there is a possibility of sharper than expected global economic growth. They expect it to slow more than what the expectations are, especially in the countries like China and Europe. Moving on to the European markets, where all the indices, they closed in the green. There are hopes of a faster US-China truce. Also, amid earnings, there was some positivity that we saw in the stocks. Well, auto stocks, they actually led all the gains, which had higher exposure to the Chinese economy. Some stocks that didn't do so well included Sainsbury. That stock plunged around 17% because there were doubts over its merger with Asda. The other stock that was in focus was UBS, plunged over 3% because it had tax laundering charges against the company. Moving on to the Asian markets, the cues are looking quite mixed out there. Nikkei, Kospi and Shanghai are seeing some red. We are seeing minor gains on Hang Seng. But if we talk about SGX Nifty, there we are seeing some red. And so that indicates a tepid start for Indian markets. Back to you.
That now the SGX Nifty is at the lowest point, down about almost 41 points. So let's see how the start is for our own markets. But the big global story remains the release of the Fed minutes of its January meeting, which showed that the central bank is still in pause mode and may not hike rates anytime soon. As well, it shows that policymakers have a timeline of the Fed's balance sheet. CNBC's Steve Leisman has this report.
We learned in the minutes to the Federal Reserve's January meeting that almost all Fed members want to end the balance sheet reduction this year. That's news to markets who saw the $4 trillion balance sheet from the Fed being run off well into 2020. But the Fed said announcement it should announce, quote, before too long, a plan to stop that reduction later this year. And that could come, by the way, as soon as the Fed's March meeting. Now, the Fed noticed that markets thought it was too inflexible on how it was reducing that balance sheet, not paying enough attention to economic data and changes in the risk outlook. So the Fed adopted a patient and flexible policy approach, and that's what led to that new statement on the balance sheet at the end of the January meeting. On the critical issue of interest rates, the Fed explained its pivot to a pause from gradual increases because growth risks had increased, financial conditions had tightened. The Fed expected slower growth in 2019 than it previously had. The Fed also saw softer business and consumer sentiment and was concerned also about the outlook for foreign growth. At the same time, inflation numbers were muted, so the Fed saw little risk in pausing. Some in the FOMC thought the Federal Reserve might return to hiking rates in 2019. Others thought not. We'll have to watch the data, listen to Fed speak over the next coming months to know if the Fed might hike again in 2019. Steve Leisman, CNBC Business News, Washington.
Okay, on that note, let's take a quick break. Our list of top 10 stocks is lined up in just moments from now. Do stay tuned in.